Joining us now is Michael Feroli, the chief U.S. economist at JPMorgan. It's great to see you, Mike. Welcome.
Good to see you, Kelly.
So I have that right, correct? I mean, because I almost had to. I don't believe it. I can't. Tell me, no move this year, and then a hike next year.
Sure. Let's take the near term first. I mean, I think after we saw the data this morning, we think inflation, core PCE inflation next week will be above 3%. And then that retail sales data suggests that GDP growth in the fourth quarter will continue to run strong. So I think the case for a cut in the near term is pretty weak. Then as we look out longer term, the case for a cut is that rates are accommodative. Again, I think if you look at financial markets, I think if you look at GDP growth, it doesn't look like, that rates are restrictive. And I think if you look at financial markets or GDP growth, it doesn't really feel like rates are restrictive when we see how strong those variables are performing. So I think as time goes on, I think the FOMC will be revising up their estimate of what the neutral interest rate is. And as that occurs, I think the case for a rate cut goes down.
So this is very similar to what Larry Lindsey was saying earlier this week. He said he thinks that Chair Powell needs to make a clearer case to the American public that rates are already accommodative or easing or whatever word you want to choose. And the way that he looked at it, I think he cited, 2.8% on core PCE and a 1% neutral rate or something. You can add this up better than me, but said, if that's 3.8% and we're at 3.6, in other words, the Fed is already pressing on the gas. It's already. Do you think that's true? Because I know others would say if you look at the more recent kind of forward-looking inflation data, maybe inflation's, lower than that. And so that's not necessarily the case.
I wouldn't necessarily say the Fed is pressing on the gas. But again, I think the case that the Fed is restraining the economy with rates in the high threes just doesn't really kind of jibe up with what we're seeing, again, not only in the real economy, but also in financial markets, which are generally pretty boomy right now. So that doesn't feel like the Fed is holding back the economy or markets for that matter.
If everything is strong on the economic front, why is the labor market so weak and the unemployment rate rising or, has risen 1.2, something like that? Normally not a great sign.
Right. Now, certainly a lot of the slow growth we're seeing in jobs is due to slow growth in labor supply. Now, you're right that the unemployment rate has been gradually trending higher, though we did see in the most recent print it came down some. And so that upward momentum seems to have been arrested over the past few months. So, again, I think you're right to point to the unemployment rate, but it isn't looking quite as worrisome as it was, let's say, a few months ago.
And when we say we added, I think, was it 50 or 40,000 jobs last month, and same with the month prior. The month before that was really bad in October. But is that good enough that, can we add jobs at around 40 or 50,000 a month and feel good about that versus when we used to add 150 and 200,000? And that's what I think to many people, myself included, still feels normal.
Yeah, so I think we do have to get used to a new normal in job growth, which is to say, given demographics, given changes in immigration policy, the new normal may be something like 0 to 50,000. That should be enough to absorb new entrants into the labor market without seeing upward or downward pressure on the unemployment rate. So it is, again, there's definitely some sticker shock, I think, of getting used to this new normal, but I think it's going to be with us for a while.
Do you think that's why the 10-year yield, which had started last year closer to 5%, came all the way down below 4 in late October, and it's kind of stalled out and then reversed higher again? Do you think that's what's going on here?
I think that's part of it. Obviously, you've had the Fed moving in that period as well, so I think that's been certainly a factor as well.
Yeah. So, Mike, if you were the Fed chair, then what you're saying, they're meeting in a couple of months. And by the way, I'm not trying to bring you into that discussion, but they are meeting in a couple of weeks. We had gone from the market anticipating a couple of cuts this year, and I don't know where we're priced right now, probably still for 1 or 2. Yeah. Which means if you're right, and if the Fed believes this, the market would be caught way off sides. Not to mention it would be a political, explosion.
Yeah. So I think the market already, has little doubt that the January meeting should be no action. And I think as we go through the year, the market can gradually reset its expectations. Now, some of that is probably pricing in some tail risk that you could see a recession, in which case we're going to cut a lot more than 25 basis points. And the market may also be perceiving a little bit of political influence seeping into Fed decisions, which we don't foresee.